Hi, hello, welcome to all of you. This is Dr. Manjunath N, Assistant Professor from Department of Commerce and Management Studies, Government First Grade College, Srinivaspur. This session is particularly designed to BBA 5th semester students of Bangalore North University. In this session, we are going to discuss about the subject called investment management. The topic for the session 44 is portfolio evaluation. Before going to discuss about this portfolio evaluation, let us recap the previous class. We have discussed about rebalancing the portfolio as an introduction part in the previous class. The main objective of this chapter is to provide an interview of portfolio management strategies, portfolio revision and rebalancing, and apply the various measures for evaluating a portfolio. Once the students attend this particular session, he will be able to understand the concept of portfolio evaluation. Portfolio evaluation is the last step in the process of portfolio management. Portfolio evaluation is the stage where we examine to what extent the objective has been achieved. Through portfolio evaluation, the investor tries to find out how well the portfolio has performed. The portfolio of securities held by an investor is the result of his investment decision. Portfolio evaluation is really a study of the impact of such decisions. Without portfolio evaluation, portfolio management would be incomplete. Portfolio evaluation refers to the evaluation of the performance of the portfolio. It is essentially the process of comparing the return earned on a portfolio with the return earned on one or more other portfolios or on a benchmark portfolio. Portfolio evaluation comprises two functions: performance measurement and performance evaluation. Performance measurement is an accounting function which measures the return earned on a portfolio during the holding period or investment period. Performance evaluation addresses such issues as whether the performance was superior or inferior, whether the performance was due to skill or luck, etc. While evaluating the performance of a portfolio, the return earned on the portfolio has to be evaluated in the context of the risk associated with that portfolio. One approach would be to group portfolios into equivalent risk classes and then compare returns of portfolios within each risk category. An alternative approach would be to specifically adjust the return for the riskiness of the portfolio by developing risk adjusted return measure and use these for evaluating portfolios across differing risk levels. Need for evaluation. Evaluation is an appraisal of performance, whether the investment activity is carried out by individual investors themselves or through mutual funds and investment companies. Different situations arise where evaluation of performance becomes imperative. These situations are discussed in the following slides. Number 1, self-evaluation, where individual investors undertake the investment activity on their own the investment decisions are taken by them. They construct and manage their own portfolio of securities. In such a situation, an investor would like to evaluate the performance of his portfolio in order to identify the mistakes committed by him. This self-evaluation will enable him to improve his skills and achieve better performance in future. Number 2, evaluation of portfolio managers. A mutual fund or investment company usually creates different portfolios with different objectives aimed at different sets of investors. Each such portfolio may be entrusted to different professional portfolio managers who are responsible for the investment decisions regarding the portfolio entrusted to each of them. In such a situation, the organization would like to evaluate the performance of each portfolio so as to compare the performance of different managers. Number 3, evaluation of mutual funds. Investors and organization desirous of placing their funds with mutual funds would like to know the comparative performance of each so as to select the best mutual fund or investment company. For this evaluation of the performance of mutual funds and their portfolios becomes necessary. Evaluation perspective. Evaluation may be carried from different perspectives or viewpoints such as number 1, transaction view. An investor may attempt to evaluate every transaction of purchase and sale of securities. Whenever a security is bought and sold, the transaction is evaluated as regards its correctness and profitability. Number 2, security view. Each security included in the portfolio has been purchased at a particular price. At the end of the holding period, the market price of the security may be higher or lower than its cost price or purchase price. Further, during the holding period, interest or dividend might have been received in respect of the security. Thus, it may be possible to evaluate the profitability of holding each security separately. This is evaluation from the security viewpoint. Portfolio view. An investor may attempt to evaluate the performance of the portfolio as a whole without examining the performance of individual securities within the portfolio. Here, by seeing this particular diagram, you are able to understand which are the various measures that we use to measuring the portfolio evaluation. Here, three models that we can see to measure the portfolio are evaluating. Sharpe's measures, second one, Trainer's measure, and Janus measures. Here, let us discuss about Sharpe's measures. Sharpe measures performance. Sharpe performance index gives a single value to be used for the performance ranking of various funds of portfolios. Sharpe index measures the risk premium of the portfolio relative to the total amount of risk in the portfolio. This risk premium is the difference between the portfolio's average rate of return and the riskless rate of return. The standard deviation of the portfolio indicates the risk. The index assigns the highest values to assets that have best risk adjusted average rate of return. And we have one more model that is, and this kind of shapes measures can be calculated by using simple formula, that is SI is equal to risk premium minus risk free divided by standard deviation of portfolio. We have another model to measure the portfolio, that is trainer's performance index. To understand the trainer index, the investor should know the concept of characteristics line. The relationship between a given market return and the fund's return is given by the characteristics line. The fund's performance is measured in relation to the market performance. The ideal fund's return rises at a faster rate than the general market performance when the market is moving upward and its rate of return declines slowly than the market return. In general market performance, when the market is moving upward and its rate of return declines slowly than the market return in the uh, market return in the decline. The ideal fund may be place its fund in the treasury bills or short sell the stock during the decline and earn positive return. With the help of characteristics line, trainer measures the performance of the fund. The slope of the line is estimated by the following formula, that is Tn is equal to portfolio average return minus riskless rate of return divided by beta coefficient of the portfolio. We have another model to measure the portfolio, that is Janus performance index. The absolute risk adjusted return measure was developed by Michael Janus and commonly known as Janus measure. It is mentioned as a measure of absolute performance because a definite standard is set and against that performance is measured. The standard is based on the manager predictive ability. Successful prediction of the security price would enable the manager to earn higher return than the ordinary investor expects to earn in given level of risk. The basic model of Janus is given below. RP minus intercept plus beta into RM minus RF. Janus evaluation of portfolio performance involves two steps. Using the evaluation, the expected return should be calculated. With the help of B, RM, RP, he has to compare the actual return with the expected return. If the actual return is greater than the expected return, then the portfolio is considered to be functioning in a better manner. To summarize this session, the portfolio performance evaluation involves the determination of how a managed portfolio has performed relative to some comparison benchmark. The evaluation can indicate the extent to which the portfolio has outperformed or underperformed or whether it has performed at par with the benchmark. Dear students, let us understand this concept by going in depth through the multiple choice questions. We have 5 questions and each questions will have 4 options. You have to choose one best option in the given slide. The first multiple choice question asks the fill in the blanks. Through dash, the investor tries to find out how well the portfolio has performed. Option A, assets evaluation. Option B, interest evaluation. Option C, portfolio evaluation. Option D, performance evaluation. Can anybody tell the answer for this? The answer is option C, portfolio evaluation. The second question asks, dash gives a single value to be used for the performance ranking of various funds or portfolios. We have 4 options. Option A, Henry's performance index. Option B, Joseph's performance index. Option C, Sharpe's performance index. Option D, George's performance index. Anybody guess the answer for this? The answer is option C, Sharpe's Performance Index. We have one more question. To understand the dash, an investor should know the concept of characteristic line. The relationship between a given market return and the fund's returns is given by the characteristics line. We have four options. Option A, economic index. Option B, consumer index. Option C, trainer index. Option D, price index. What could be the answer to fill in this blank? The answer is option C, trainer index. Similarly, we have one more question. The absolute risk adjusted return measure was developed by Michael Janes and commonly known as dash. Option A, Johnson measure. Option B, Janes measure. Option C, Henry's measure. Option D, James measure. What could be the answer for this? The answer is option B, Johnson measure. We have another question. What is the formula for Johnson measures for portfolio evaluation? Option A, RP minus intercept plus beta into RM minus RF. Option B, RM minus RF plus beta is equal to PR. Option C, beta minus RF plus RP is equal to RM. Option D, RM minus intercept into RP plus RF. What could be the answer for this? The answer is A, that is RP minus intercept plus beta into RM minus RF. Dear friends, there are so many reference books are available on this particular topic. You need to go through the textbooks in order to understand the given topic in depth. There are so many articles and research papers and textbooks are available in which you can gain ample of knowledge with respect to measuring of portfolio or portfolio evaluation. Thank you for your patience listening. Good luck all of you, and thank you once again.